On Monday this week, we looked at Polymetal International, the first mining company that we looked at on this show. Today, we're going to take a look at another mining company. Hey there guys, welcome to the FTSE Show with me, Chris Chillingworth. This is a show where we dissect UK FTSE companies to look for evidence, look for signs that these are companies that are going to grow over the next 10, 20 years by about 300, 400% in value ideally. We're looking for the criteria that generally tends to be present with these companies, the kind of financial performance that we're looking for. We want strong companies with fantastic net earnings, with fantastic revenue growth as well, but they need to be able to keep that money. We want to know what they're doing with those profits as well, and what they investing in them in assets, and are those assets income producing assets, or are they putting them into retained earnings? Are they running a acquisition strategy? If so, what kind of companies are they buying? All of that kind of stuff. So yeah, we go into depth on that on this show, and that's what we're trying to identify. Today we're going to take a look at the second mining company that we looked at on the show. So I mean, you know, maybe I should have spaced them out a little bit, but we did Poly last on Monday, and I felt like doing another mining company today. So we're going to look at Rio Tinto PLC today. Huge mining company, FTSE 100 constituent. And yeah, very interesting numbers, certainly compared to Polymetal, which was partially the reason why I wanted to do this today, is to give a very like-for-like comparison between the two companies. I appreciate that whilst they're in the mining sector, they are slightly different companies in terms of what they're mining. But yeah, very interesting to look at the financials. So without any further delay, let's do just that. Okay then guys, so let's take a look at Rio Tinto. Epic code is RIO. These guys are in the FTSE 100 and they're in the mining sector. So first of all, forgive the noise in the background. We've got loads of construction work going on. You're just going to put up with it. Hopefully it won't bleed through too much. So we took a look at, who was it we looked at last week? Polymetal International Mining Company. We're looking at Rio Tinto this week, and the numbers are very different. So this is a much larger company, much bigger. Back in 2008, these guys were bringing in a revenue of 54.2 billion a year. Now, this is a very important starting point because, as you can see in 2019, they're not making anywhere near that. Now, we're still talking about a huge company, but there has been a decline. As you can see, it's kind of up and down, right? There's years where we've seen a bit of a drop and then it comes back up again, and I think this might be relatively common in the mining sector. I haven't analysed enough mining companies to really get a true picture of that, but I can imagine with the exploratory nature of this particular industry, that might make sense. But we can see here 54 billion in 2008, down to 40 billion, then back up to 55, up to 60. 60 was the peak, which doesn't bode well for the rest of the analysis, right? If their peak was back in 2011, but it was 60 billion, 60.5 billion was the peak of the revenue for Rio Tinto back in 2011. Then down to 50 again, 51, down to 47. 2015 down to 34 billion, down to 33 billion in 2016. So significant decline between 2011 and 2016, from 60 to 33 billion, almost halved the business. So that's quite significant and something that we obviously need to bear in mind. Certainly when we look at the chart and see what effect that had on share price, very interesting. Then we've seen somewhat of a recovery, because from 2016 to 2017 jumped up from 33 billion to 40, stayed at 40 for 2018, then up to 43 in 2019. So we've seen somewhat of a recovery, but we're still, you know, a long way off from the 54 billion they were making in 2008, for instance. So yeah, not as strong a company as they were a long time ago, you know, over 10 years ago now. But they have done better over the last, let's call it the last 4 years, from 33 to 40, stayed at 40 and then up to 43 billion. Taking a look at the expenses, the company expenses, they're actually okay. I mean, they're very high, obviously. 2008, the expenses were at 37 billion. Today, they're only at 27 billion, so that's important. because what we've seen therefore is with the drop-off in revenue, we've also seen a drop-off in expenses relative to the size of the revenue. And you can see here, if we were to highlight all of these years, something that I tend to like to do, highlight 2008 to 2018 to get a average expenses rate. We're looking at 71%, which is fine. That's actually decent. To spend 71% of your revenue on expenses of running the business, that's fine as long as we haven't got any other huge costs that are going to really eat into the profits. But generally, by the time you've got to expenses, there hopefully won't be. Expenses are generally the crux of the cost of running that company, right? We're at 63% now, so we've actually seen quite a significant decline over the last 5 years. Because if you look at 2015, we're looking at 80% of the profit was being eaten up by expenses, down to 79% and 67 and 60, kind of pretty much staying at 67, and then down to 63% in 2019. So over the last 5 years, we've definitely seen a decline in the expenses, but we have seen an increase during that period in revenue. So that's very interesting. Revenue's gone up, expenses have gone down. Very useful for profit making. Let's come down to the interest on debt. Interest on debt levels historically have been very high, but they haven't been now for the last 4 years. They've been trading and operating at a level where the interest on debt has been quite affordable, or not too much of a suck from the profit. And then we can look at the historical profit margin of this company. They're doing pretty well. Not as impressive as Polymetal last week, or on Monday, sorry. Nowhere near as high as the 30% a year that we're making, that company were making. But Rio Tinto, a much larger company, but a less efficient company relative to their size, because these guys are only making something like 15 to 20% a year. But we're starting to see that creep into the 25s now. So if we again highlight all these years, bar the last year, we're looking at an average of 18.5% earnings profit margin. But as of 2019, that's at 25%. So that's really good. You can't argue with 25% net earnings. That is fantastic. That's a huge amount. And again, we've seen years where it's dropped all the way down to 3%. 2015 was a relatively poor year for Polymetal. There was one of the lowest points of the revenue. And we saw the highest point of the expenses almost in terms of percentage ratio. And we saw interest on debt rise to the highest level that we'd seen at 4.7 billion. So, it was all these kind of costs just coming in at once, revenue falling as well. It led to only making 1.2 billion, which for this company was quite small, only a 3.5% net earnings. But other than that year, 2015, they've done fantastically well. They've been a fantastically strong company. Looking at the balance sheet, they've got a 1.6 current ratio. That's okay. So 1.6 times assets against liabilities. That's fine. They've got high levels of cash at 8 billion in cash. So this is a fairly substantial business, right? Of course they are. But let's take a look at the long-term debt. 13.3 billion. Sounds like a hell of a lot. It's been a lot higher in the past, sitting here at 24 billion, for example, in 2013. Now at 13 billion, but what is that in relation to the earnings power of this business? Well, in 2019, they made 11 billion, so they could pay that debt back in about 1.2 years. Absolutely fine with that. This is a company that, yes, they're borrowing 13.3 billion, but the size of this business and the amount of money that they make in terms of profit means that if they needed to pay off that debt, they'd be able to do that. They've got the capability of being able to do that, and doing that relatively soon if they had to as well. So I'm more than happy with that. No concerns with that at all. This is a company that are buying back their own shares, bought 1.5 billion worth of their own shares last year, 5.3 billion worth of shares the year before. So some focus there on buying back their own shares. I like that. It reduces the dilution of shares out there on the market, increases your holding if you're a current shareholder. It also raises demand because there's less supply for those shares now. So it's all good. It generally will help to raise share price. Retained earnings was at a high of 32 billion 2010. We saw it at 26 billion by 2014. It's down to 23 billion over the last 5 years, we've seen an average decrease in retained earnings of 0.9%. So really what we're saying here is there hasn't been a hell of a lot of growth in retained earnings, but we haven't seen much of a decline either, so that's not too bad. So all in all, this company does not impress me as much as Polymetal International did. They're not as efficient as a company. They're not making as much net earnings. They have seen that relatively long-winded drop-off in revenue. We've seen some recovery over the last 3 years, but it's not quite recovered. If you remember Polymetal on Monday, they far exceeded the previous highs that they'd had before that decline that they went through. They recovered and then some. Whereas Rio Tinto, they haven't achieved that yet. They've gone through a period of decline. They've started to recover, but they haven't gone higher yet, and there's no guarantee that they will. But a less efficient company as well, because they're not making as much profit margin. They're not making as much net earnings as Polymetal was. Still impressive, just not quite as powerful. And then again, the balance sheet doesn't look as strong either. The current ratio, I think, for Polymetal was something like 3 times the assets against liabilities. Here it is only 1.6. No issues with long-term debt. And then the other issue is the fact that retained earnings isn't really growing. We saw it in 2018 at 27 billion. Now it's down to 23 billion. It's not really going anywhere. We're sitting at 23 billion. Well, this company was sitting at 23 billion back in 2013. So we're just not seeing any growth in retained earnings. They're keeping that money in there, but we're not seeing any growth. And that's a shame, because we want to see that retained earnings increasing to help share price growth as well. Return on shareholder equity is healthy at 24%. Overall, a very strong business, a very strong company, worth investing in. Yes, I would say so, depending on the price that we can get the shares at. Let's go and take a look at the share price and see how it's done over that period of time. Okay, so this is the Rio Tinto share price. Now, look at 2008. In this period here, we've seen highs in May 2008 of £59 a share. It fell all the way down to £12 a share from £59 a share in 2008-2009. That would be the financial crisis, I suspect. That would have had an impact on that. And that would probably correlate with this drop from 54 billion to 40 billion in terms of revenue income. Then we saw the recovery. We saw the recovery in the numbers. We're seeing the recovery here on the chart. But if we take a massive step back here, I'm literally leaning back in my chair as I say that, and we look at the full picture here. What we've got here is a company that really is still at the same level it was back in 2008. We've seen a recovery since the decline covering this kind of period here of 2008 down to about 2016, and then the last couple of years we've started to see somewhat of a recovery, but not back to the previous strength that we had with Rio Tinto in the past. And the share price is moving, it's doing okay, but we are still at the same levels as 10 years ago. If you had invested in this company 10 years ago, yeah, I mean, this has not been as strong a company as Polymetal. And I prefer Polymetal to Rio Tinto, just looking at the numbers. And we can see here with the chart, we've not really seen much growth either. So we've seen some recent growth, which means they may well be on their way to surpassing that kind of 2008 era and actually moving past that now and moving up. That may well be the case with this company. Personally, I prefer companies like Polymetal that stand out as real strong. They may be way smaller a company, but far more efficient with the profit margins that they're making from their business and how much they're pumping into retained earnings and all the signs of growth that Polymetal are showing. Whereas Rio Tinto starting to show early signs of growth, but still stagnant in some areas. Still not the exciting growth that I'd like to see from them. And I guess, we often find these much larger companies find it far harder to grow at the same rate as a smaller company might. And so it's for that reason that I'm usually invested in slightly smaller companies, because they've got more potential to grow in share price than some of these big corporate giant companies like Rio Tinto that are going to struggle to really grow that revenue and retain enough of that for huge profits. But they could do it. I'm not, I don't want to speculate. I don't want to try and predict here. I can only look at the facts. The facts suggest this is an okay company. I suspect they'll get a average score from the leaderboard. Let's go and take a look and see how they got on. Okay, so a bit of a mixed bag, really. Not a bad company by any stretch, and there's some impressive numbers there for sure. Very, very large company. There is a feeling that maybe they aren't going to grow so much as they have done based on those financials. But I want to show you some figures now, or talk to you about some figures now that will probably sway you a little bit more. So current price at time of recording this is £47.73 a share, so quite expensive shares. However, when we say expensive, they're actually not. The earnings per share for Rio Tinto is £4.87 per share. It's very high. And what that suggests is that if we were to buy all the outstanding shares in this company at £47.73 per share, then we would be getting an earnings per share rate of 10.2%. We'd be getting 10.2% on our investment if we were to buy Rio Tinto, the whole company. That's pretty good. I mean, there's not many companies where you get a 10% return on the current share price. Most of the companies across the FTSE these days seem to be overpriced, certainly, and Rio Tinto don't seem to be one of those companies. And if you remember back on Monday, we looked at Polymetal International, that was 6.2%. So Rio actually suggests that whilst the share price is higher, for what you're getting for your money, it's actually a decent price. It's actually a very well competitive price, a good competitive price with a margin of error incorporated there in that 10%. And then there's another way that I like to look at the price as well. I always kind of do a two-pronged effect approach. We can look at the number of shares outstanding at 1.25 billion shares, but the equity in the company, the assets minus the liabilities equals the equity, stands at 45.2 billion. So if you were to take that equity and divide it by the number of shares outstanding, you'd actually get a net asset per share, or an equity per share, of £36. Now, bear in mind the share price is £47. We're looking at about 75%, which is a price to book ratio of 1.3. That tells me that that price is very competitive. When you're getting, for every share you buy, you're getting 75% of assets in that price. That's very good. So Rio have a very competitive price. Now, I want to make it something very clear, because some people don't quite get this yet. They've been watching the show for a while, they haven't quite understood it. When we look at the financials and we're looking at these scores, this is purely based on the financials of the company, the financial performance, the trends, the underlying trends within the financials. We're looking at obviously historical data, no future data. We don't have our hands on that. So we're only looking at what's happened in the past, and we are scoring this company in terms of their odds of being a strong 300 to 400% growth company over the next 10 or 20 years. That's what we're doing. By scoring high or scoring low, it's not necessarily a reflection on the quality of the company, but more so the odds that they are likely to do what we need them to do as a long-term investor. And with the price is entirely separated. So you can have a fantastic company that is ticking all the boxes, financially doing a fantastic job, but their share price is just astronomical right now, and you wouldn't want to buy the shares, not because it's a bad company, but because the share price is just far too high relative to the value of what you're getting from that business for those shares. And so there are many companies that I found that are fantastic companies, but I don't own any shares in them yet because I'm waiting for a more competitive price. The price just doesn't make sense right now. Obviously, we've also got the flip side. So you've got very poor companies out there, companies I would never think of investing in, that are just not ticking any of the boxes, have very little odds of being the sort of company that I'm looking to find, but have very competitive share price right now. and relative to the underlying value of that business, the share price based on these particular metrics looks very, very good. So they're two separate entities, if you will, and maybe we could one day come up with a scoring algorithm for the pricing procedure, but I don't feel that's particularly necessary right now. So with that explained, I'm going to add Rio to the board. Okay, so Epic code RIO, Rio Tinto, and some may be surprised by this particular score, but it is right relative to the algorithm I have set, which rewards based on the right behaviours that I'm looking for in terms of the financials and what they're doing with those financials. And scores badly for the more negative aspects of it. Rio Tinto PLC score 41 points. So they are relatively low on the leaderboard. Now this is separate, remember, to the price. So here we've got a company that have scored relatively low. That means the odds are relatively low that this is a company that I want to invest in because they're going to achieve that 300-400% share price growth over the next 10-20 years. The odds are lower than Polymetal International. However, if you did like this company, if you did like the financials, if you didn't really agree with this 41 points and felt that it should be higher, share price right now is, I think, fantastic. I think it's a great value at £47 relative to what you're getting from the business, the value that you're getting, the amount of assets that you'll be buying, the earnings that you'll be getting off the back of that. Now, obviously, that money doesn't go into your pocket, but it's a way of pricing the shares to know whether or not you're getting a good price or whether or not you're getting ripped off, essentially. So let's get these guys on the board. Okay, so they find themselves in 20th place. I think that's right. I know some of you probably won't agree because Rio are a very popular stock. But hey, it's the same algorithm for all these companies. And I am looking for a particular quality and caliber of company that are meeting the criteria. And so they just don't tick the boxes for me, unfortunately. They're just not quite good enough there. But that share price looks very sweet. And so you might be getting some decent price shares right now and be in for a bit of a treat. We've lost Card Factory. We only literally did these the other day and they've already gone, unfortunately. So they are out of the picture. We've got one minus company left on the leaderboard. They ain't going to last very long, obviously. So they'll be going pretty soon as well. Otherwise, all I wanted to say was thank you very much for your support. Thank you for the likes and everything. And thank you for your comments on the videos. I will see you guys next week on Monday. Cheers.